Let's take a look at this one. This is a break-even in analysis and planning future sales problem. Wright Company has a maximum capacity of 200,000 units per year. Variable manufacturing costs are $12 per unit. Fixed overhead is $600,000 per year. Variable selling and administrative costs are $5 per unit, and fixed selling and administrative costs are $300,000 per year. The current sales price of what they make and sell is $23 per unit, and we're asked to solve those three requirements that you see on the screen. First, let's tackle number one. What is the break-even point in sales units and sales dollars? Okay, variable costs are 12, variable selling and administration are 5, current selling price is 23, we've got fixed overhead of 600,000. Let's take a look and see if we can solve that. Now, I've done this ahead of time, so all I'm going to do is bring it to light for us. So let's turn this into black lettering so that you can read it. So break-even units is computed by taking the fixed cost over the contribution margin per unit. So the fixed cost were $600,000, and let me see if I had anything else here to bring into light. The $600,000 was the fixed cost. The $23 represented the selling price. The variable cost was $5. So we add the variable cost also to the other. The variable selling and administrative were $5, and the manufacturing cost were $12. So we add those together, and there was also administrative costs of $300,000. So the fixed overhead was $600,000. The fixed administrative cost, and you can think of administrative cost as being a fixed cost, running $300,000. So we add the two fixed costs on top. We take the sales price less the variable cost, combine them on bottom, and we are able to calculate that break-even is equal to 150,000 units. Now, if we wanted to turn that into break-even dollars, we take the 150 units times the $23 to come up with 3,450,000 is the break-even point in dollars. Okay, now jumping back, number 2 says, how many units must Wright Company sell to earn a profit of $240,000 per year? All right, now if you remember the formula, let me just bring number 2 to light here. Here's the formula with targeted sales. We take the fixed cost plus the desired profit and divide it over the contribution margin. So the only thing we need to change is add in that $240,000 to the $900,000 we already computed as being the fixed cost, divide it by the contribution margin, which we calculated here, and we're able to come up with, let me slide down so you can see all of this, a targeted sales units of 190,000 units on this problem. Okay? All right, now number 3 says, a strike at one of the company's major suppliers has caused a shortage of materials, so the current year's production and sales are limited to 160,000 units. To partially offset the effect of the reduced sales on profits, management is planning to reduce fixed cost to 841,000. Variable cost will remain the same, and the company's already sold 30,000 units at its regular price of $23 per unit. So the question asks, what amount of fixed cost were covered? And I think we need a question mark here. And let's go give that a try. All right, let me slide back up. That's not what I want to do. I just want to bring the lettering to light. Okay, so here's what we know on Part A. We've got the selling price minus variable cost per unit is equal to the contribution margin per unit times the number of units would equal the fixed cost covered. So we take the 23 less the 17 to come up with $6 times the 30,000 units is 180,000. Okay, and the 30,000 units is what we already sold. Okay, then and that takes care of Part A, which says what amount of fixed costs were covered. Well, 180,000 were already covered. Now, Part B says what contribution margin per unit will be needed on the remaining 130,000 to cover the fixed cost and earn a profit of $210,000. So again, we have a targeted profit that we need to resolve. So we add in the profit right in the formula, right there you see the P, divided by the number of units to come up with the contribution margin per unit. So if we bring that to light, we know that we have the 841,000 of fixed cost is what they're shooting for, right? There's your 841,000 minus the 180 we've already covered, plus the 210,000, which represents the profit we're shooting for, right? And divided by the 130,000 units. And if we lay that all out, we're able to calculate $670 per unit. Okay, now just a little narrative on this one now that we'll read is at sales of 160,000 units, the total required contribution margin equals the targeted profit plus the revised fixed cost. That's the 841,000. Okay, and then the proof is shown here. Take the required contribution margin of 210 plus the 841, you come up with 1,051,051, less the contribution margin already generated, right, 180,000. So the balance left to be generated is the 871, which appears right there. If we take the required contribution margin on the balance to be generated divided by the remaining sales, we plug and chug, if you will, and we can come up with 871 divided by 130,000 units, and we get that 670, which we proved right there. Okay, so this is a more complicated version of break-even with a target income, but we have solved the entire problem. So thank you, everyone.